Kanishka Setia, Director and CEO at Western Carriers, speaks to NDTV Profit. Kanishka, good afternoon and welcome to the show, and a pleasure to speak to you at NDTV Profit. My first question coming to you is, in terms of the order from Jindal Stainless, 558 crores, what's the execution timeline and what's the kind of revenue recognition profile that you see out of this?
Good afternoon and thank you for having me on your show. It's a pleasure to be with you. The order execution for the 558 crores is over 3 years timeline, starting from the 1st of July till the 30th of June 2028. It is an order for domestic movement of 3 products: slabs, coils, as well as sheet plate, in specially designed 40 feet open top containers that we've designed for Jindal Stainless. And so this is going to be a pan-India movement servicing all corners of the country for the next 3 years. So it gives us great visibility and it gives us an opportunity to create the capex that is required for doing this project in a timely and professional way.
Mr. Setia, very good afternoon to you. Thanks so much for joining in. It's Puneet this side. In terms of the breakup of this particular order book, in terms of revenue, you mentioned that it'll be till over 3 years by 2028. What is the portion that you're trying to recognize and finish in this particular year as well as the next year? So will it be roughly about 40% over the next 2 years and then the rest, or if you can give any kind of range at least for our viewers?
Sure. So this order starts 1st of July, which is day 1 of Q2. And so we will be able to book revenues of 9 months in this year and 12 and 12 in the subsequent 2 years as well. We expect the orders to sort of build up. As you know, we are a derived industry, sir. So what happens is usually, if Jindal Stainless, as you know, has been on a stellar growth record of the recent years. So we are hopeful that we should be able to, keep growing on with them, piggybacking on their success and providing the logistics and, supply chain support that they need.
Kanishka, my question is, in terms of the other orders that you've got as well, and if I look at your previous year's revenues, this order comes in almost as 1/3 of your FY25, FY24 revenue profile. Does this mean that this is going to be it? Another 2/3 or a little more is what you plan to clock in? Or how much is the kind of expansion you're looking at in terms of your top line margins and bottom line for FY26 and the subsequent years?
Fair question. So 1/3 of these revenues will get derived every year. So we're looking at anywhere from 180 to 200 crores of revenue, which currently is about 10-12% of our current turnover. So it's a large order, but it's not 1/3 of what we are currently doing. We also have large orders from other stellar corporates like Vedanta, which gave us almost an 1,100 crore order earlier in this calendar year, I think, which is one of the largest logistics orders in combination with what we've just achieved from Jindal Stainless. So what I want to say is that the work orders that we have, they give us a broad opportunity to actually, run the supply chains in a very efficient way for our customers. These are all long-term work orders spanning 3-4 years in most cases. So we have a very good, future outlook. We have very good order books for the next 3 years and 4 years. And so we have enough time and plenty to actually plan our supply chains and our capex around what our customers need. So we are seeing very, very, strong demand from our large corporate customers, and we are planning, our supply chains around that.
Mr. Setia, just one question on, in terms of last year, because we've seen that the EBITDA margins have also taken a slight hit compared to FY24, while essentially the working capital days have also been increased to about 111 for the year. How do you plan to mitigate both those aspects going into next year? Because even when you came for an IPO, the EBITDA margin used to be stable at around 8% for the year, a couple of years before. So if you can address that aspect, and what should be the expectations over the next year?
Puneet, I want to say that, last year was an exceptional year. We derive a large amount of our revenues from our customers doing EXIM business. And EXIM business had really strong headwinds last year, to put it politely. the supply chain disruptions, not only for us, as a country or as a company, but globally was massive. So, the erratic vessel schedules, erratic transshipment port movements, erratic vessel arrivals, that played havoc on the margins, which was basically hit because of the EXIM business. Now, with the prospect of large-scale return of container ships to the Red Sea following the recent ceasefire, and we pray and hope that it holds. This is a great opportunity for us as a company that we are hopeful that this should flood the market with shipping capacity as global TEU per mile demand would decline by about 6% basis what our understanding is. And if this happens and there is large scale return of container ships into the Red Sea and Suez Canal instead of the larger route around Cape of Good Hope in Africa, what it does is it reduces your transit times as well as it increases the supply of vessels. And so if your transit times reduce and the supply of vessels increases, that should dramatically reduce freight rates for EXIM trades.
So, Kanishka, my question to you is then the kind of decline that you saw in terms of profitability in the third quarter and the fourth quarter, how do you see it improving now, taking into consideration exports will bump up? And what percentage of your revenues are coming in from exports currently? To which regions?
Okay, so if we look at the container numbers for exports, we in FY24 were about 72% of our TUs, 151,000 odd, came from EXIM numbers, which declined by 12% last year to about 133,000. But what we could do, which we put in a lot of effort, is we grew our domestic business by 32% year on year last year, from about 61,000 odd in FY24 to about 80,000 in FY25. So we are seeing very strong demand from our customers domestically, and fingers crossed. If the geopolitical situation remains stable as it is for the last 2 to 3 days, we are hopeful that the EXIM demand will also take a huge spurt. So that's what we are hoping. We're already getting long-term commitments from large customers, pan-India. Large contracts we've made visible is available. You've seen what we've done over the last year or so in that, and seeing lots of demand. So we've actually, because there's so much demand that we are seeing, we have planned a major capex in this year as well. We did a capex of approximately 70 crores in the last year, and we have an intention of further doing a capex of about 100 crores in this financial as well to take care of the growing demand.
Just one last question from my side, Mr. Sethia. Essentially, what's the kind of, I'm not sure if you give this number, growth outlook for next year? And essentially, in terms of diversifying also, because you have already received an order from Vedanta, as you mentioned, now the other one from Jindal as well. The components or the contribution from the metal space is over 50% for you. Are you looking to diversify that, or is it because the growth is coming from there for you, that contribution could stay there and margins could, improve on the factors that you just mentioned?
It's a mix of both, actually. See, a lot of demand for supply chain, complex supply chain, multimodal that we do comes naturally from the metal side. But we as a company have a natural hedge in that we are not sector dependent, we are not metal dependent, nor are we customer dependent. So in metals, we work with aluminium, we work with steel, we work with zinc, and all the metals have a separate cycle. If you track them on the London Metal Exchange on LME, you will find that they go in complete variance. So that's a natural hedge that's built into the business. Over the years, we have actually also grown our business in other sectors. MSME, which was contributing almost zero of our revenues 5 years ago, is about 13-14% of our order book now. Together with industrials, adds up to about 20%. So that's a huge area of growth for us. And we look at the metal space not really growing in our portfolio than where it is, but we don't see it shrinking either. So we're looking at a mix of about 50% from metals, 25% odd from pharma and FMCG, and 25% from PSUs, industrials, as well as MSME. So that's what we're looking at going forward.
Right, a strong run that the stock has seen from the month of May itself as well. But thank you, Kanishka, so much for joining us on the show and sharing your views. And that's The stock 5.5% up move on the back of the order win that they have announced.